Warren Buffett is one of the greatest investors of all time, turning a few $1,000s into billions and teaching lessons that anyone can follow. If you're just starting your investing journey, his advice is pure gold. In this video, we'll break down 3 of Warren Buffett's most powerful ideas for beginner investors. Simple, timeless principles that can help you build wealth and avoid costly mistakes. Let's dive in. When Warren Buffett speaks about investing for beginners, there's one piece of advice he repeats more than almost anything else: buy broad, low-cost index funds. Now let's break down what this really means and why it's so powerful. First, the why. Most professional money managers, even with years of experience, research teams, and sophisticated tools, actually fail to beat the overall stock market once you include fees and taxes. That's right. The average investor who tries to pick individual stocks or pay high fees to a fund manager usually ends up with less money than if they had just tracked the market itself. Buffett has said many times that a simple S&P 500 index fund has beaten the majority of active managers over the long run. By investing in an index, you don't have to guess which company will be the next Apple or which stock will crash tomorrow. You're buying the entire market, hundreds or even thousands of businesses, and capturing the average return, which historically has been around 8 to 10% annually over decades. Now, the how. The simplest and most effective way to do this is through something called dollar cost averaging, or DCA. Instead of trying to time the market, you commit to investing the same amount every single month, no matter what the headlines say. For example, you might put $200 into an S&P 500 index fund or a total market fund every month. When prices are high, your $200 buys fewer shares. When prices are low, it buys more. Over time, this evens out, and you avoid the stress of trying to predict short-term movements. The key here is automation, setting up your brokerage accounts so money is automatically invested every month without you even thinking about it. Buffett himself has recommended that most people should simply dollar cost average into an index fund for decades and let compounding do the heavy lifting. But let's be clear, even this straightforward strategy has pitfalls. The biggest mistake is getting distracted by hot sector funds or trends. You'll often see flashy ads for funds focused on technology, clean energy, or cryptocurrencies. While these can look exciting in the short term, they're much riskier and far less diversified. A broad index fund, like the S&P 500, spreads your money across the largest, most stable companies in America. Companies like Apple, Microsoft, Coca-Cola, and hundreds more. The broader the index, the more you reduce the risk of one company or one industry dragging down your entire portfolio. Another common pitfall is turning off your investments during market downturns. This is one of the hardest parts emotionally. When the market drops 20% or 30%, the natural reaction is to panic and stop buying. But history shows us that every single major crash has eventually been followed by recovery and new all-time highs. By continuing to dollar cost average through those dips, you're actually buying shares at a discount, setting yourself up for bigger gains when the market rebounds. Buffett himself says, "Be fearful when others are greedy, and greedy when others are fearful." So, to summarize this principle, broad index funds let you own the whole market instead of trying to outguess it. Dollar cost averaging ensures you invest consistently without worrying about timing. Automation keeps you disciplined and on track for the long term, and avoiding distractions like trendy funds or panic selling during downturns is what allows compounding to work its magic. Warren Buffett has even said that if he could leave one investing strategy behind for his family, it would be this one: put 90% of the money into a simple, low-cost S&P 500 index fund, and the remaining 10% into short-term government bonds for safety. That's how strongly he believes in the power of indexing. For beginner investors, this isn't just theory, it's a roadmap. You don't need a finance degree, you don't need to study hundreds of companies, and you don't need to spend hours glued to the stock ticker. With broad, low-cost index funds, you're making one of the smartest moves possible, betting on the growth of the market as a whole. And history has shown us, again and again, that over time, the market rewards patient investors. So, if you're just starting out, remember Buffett's wisdom. Don't overcomplicate it. Buy broad, low-cost index funds, stick to the plan, and let time and compounding do the rest. One of Warren Buffett's most famous pieces of advice is to stay within your circle of competence. This principle sounds simple, but it's one of the most powerful filters you can use as a beginner investor. Let's explore why it matters, how to apply it, and the common mistakes you'll want to avoid. Why? Edges come from understanding, not guessing the stock market is full of opportunities, but not every opportunity is meant for you. Buffett says that every investor has a circle of competence, an area of knowledge where they truly understand how businesses make money, what drives their success, and what risks could harm them. For example, if you spent your career in healthcare, you probably have insight into how hospitals or pharmaceutical companies operate. If you're a software engineer, you might better understand technology companies. That knowledge gives you an edge over the average investor. The mistake many beginners make is thinking they have to invest in everything. The truth is, you don't need to swing at every pitch. Buffett compares it to baseball without strikes. You can wait for the perfect pitch that's right in your zone. Staying inside your circle ensures that when you invest, you're doing it from a place of strength, not blind guessing. How? Define what you truly grasp. So, how do you define your circle of competence? Start by asking yourself some key questions. Do I understand this company's business model? How does it actually make money? Do I understand the drivers of success? What factors cause revenue and profits to grow? Do I understand the risks? What could go wrong, and how would that affect the business? If you can't answer these questions in plain, simple language, you may be outside your circle. And that's okay. The circle doesn't need to be big. In fact, Buffett says it's more important to know your limits than to try and expand them too quickly. Now, let's take a simple example. You might know how a company like Coca-Cola makes money selling beverages worldwide. You can easily understand their distribution, their brand strength, and their risks, such as changing consumer preferences. But if someone hands you the financials of a biotech startup developing a new cancer drug, and you don't know how to evaluate clinical trials or regulatory hurdles, that's outside your circle. The good news is that your circle can grow with time and study. The more you read, research, and learn, the more industries and businesses you'll be able to understand. But as a beginner, the key is to start small, stay humble, and invest only in what you can truly grasp. Pitfalls. Familiarity versus true competence. Now, here's the tricky part. Many people confuse familiarity with competence. Just because you use a product every day doesn't mean you understand the company's economics. For example, you might shop at Starbucks every morning, but that doesn't automatically mean you know how Starbucks manages its costs, scales globally, or deals with commodity price changes in coffee beans. Similarly, you may love using an app like TikTok or Netflix, but do you really understand how those companies make money, how they manage competition, and how sustainable their business model is? Familiarity can give you clues, but competence requires deeper understanding. This is where many beginners go wrong. They invest in brands they like, thinking, I use this product, so it must be a good company. Sometimes that works, but often it leads to disappointment because the numbers behind the business tell a different story. Another pitfall is overconfidence. Beginners sometimes expand their circle too fast, convincing themselves they understand industries that are far more complex than they realize, like biotech, banking, or oil. Buffett's advice here is simple. Be honest with yourself. Admit what you don't know, and you'll avoid a lot of costly mistakes. Wrapping it up, Warren Buffett's circle of competence principle boils down to this. You don't have to know everything, just know your limits, and invest where you have an edge. Be wise, sticking to industries and companies you truly understand. You reduce risk, avoid speculation, and give yourself a better chance of success. And remember, it's not about the size of your circle. It's about how clearly you know its boundaries. For beginner investors, this mindset removes pressure. You don't need to chase every hot stock or every trend. Instead, focus on what you grasp, build your knowledge step by step, and grow your circle over time. That's how you invest with confidence. And that's how you follow in Warren Buffett's footsteps. One of Warren Buffett's favorite lessons, borrowed from his mentor Benjamin Graham, is the idea of a margin of safety. If you remember nothing else about value investing, remember this principle. Always build a cushion between price and value. Why? Valuation errors happen no matter how skilled you are at analyzing businesses. There's always a chance you'll be wrong. Markets are unpredictable, industries change, and even the best companies can face unexpected challenges. That's why Buffett insists on a margin of safety. Think of it like building a bridge that can hold 30,000 pounds, but only allowing 10,000-pound trucks to cross. The margin of safety protects you from errors, bad luck, or things you simply couldn't see coming. In investing, it means never paying full price for a stock, even if you love a business. You wait until it trades at a meaningful discount to its true value. How? Estimate value, then buy with a buffer. So, how do you apply this idea? First, you estimate a company's intrinsic value, its true worth based on cash flows, earnings power, and long-term prospects. Of course, estimating intrinsic value isn't an exact science. Different investors will get different numbers. That's where the margin of safety comes in. Instead of buying at what you think is fair value, you demand a discount, maybe 20%, 30%, or even 40% below your estimate. That way, even if you were too optimistic, you still have room for error. For example, suppose you calculate that a company is worth $100 per share. Instead of rushing in at $100, you might only buy if it falls to $70 or $80. That cushion protects you if your assumptions about growth or profits were slightly off. Buffett says it best: you don't need to know a man's exact weight to know he's fat. In other words, you don't need perfect precision. You just need enough of a buffer to ensure you're getting a bargain. Pitfalls, story stocks, and cheap traps. There are two big mistakes beginners often make when applying this principle. The first is falling for story stocks. These are companies that sound exciting, like the next big social app or a futuristic technology, but they have little or no profits. With no reliable cash flows, it's impossible to calculate intrinsic value, so you can't really apply a margin of safety. That makes them speculation, not investment. The second mistake is confusing cheap price with cheap business. A stock trading at $2 per share might look cheap, but if the business is losing money and has no future, it's not really a bargain. A true margin of safety comes from buying quality businesses below their value, not buying low-quality companies just because the stock looks inexpensive. Wrapping it up, the margin of safety principle protects you from errors, emotions, and market surprises. It forces you to be patient, disciplined, and selective. For beginners, it's a reminder that investing isn't about excitement. It's about prudence. The next time you're tempted to buy a stock, ask yourself, am I paying full price, or do I have a margin of safety? If the answer is no, wait. Because in the long run, patience is often the most profitable strategy of all. So let's quickly recap the first 3 powerful ideas from Warren Buffett for beginner investors. First, buy broad, low-cost index funds. It's the simplest, most reliable way to capture market growth without trying to outsmart it. Second, stay within your circle of competence. Focus only on businesses and industries you truly understand, and don't be afraid to admit what you don't know. Third, always demand a margin of safety. Never pay full price for a stock. Build in a cushion to protect yourself from mistakes and surprises. These timeless principles are simple, but they can transform the way you invest if you actually stick to them. Thank you for watching. If you found this video helpful, don't forget to hit the like button, subscribe for more wealth and wisdom, and share your favorite Buffett idea in the comments. Until next time, invest wisely and stay patient.